All right, welcome. We are going to be covering the equipment financing section of Nelson's book in this video. This is going to be the supplemental video to the podcast that we just recorded. And in that podcast recording, we've got a really good introduction to this section, so I'm not going to redo that here. What I'm going to use this video for is really to dive into the numbers and look at or help pull out what Nelson is trying to tell us by including some of these illustrations. There's a lot of numbers in here and it's easy to get lost. And so I'm going to go through each illustration, look at exactly what he's financing, look at the dollars that are going in and the dollars that are going out. So bear with me, there's going to be a lot of numbers, but in this part of the section of Nelson's book, I really think that we need to slow down and go through it. And so we're going to do that here today. So let's dive right into this. In this first example, what Nelson is talking about is he's talking about illustration number 1. And what we're going to do here is we're going to call this the do nothing example. And we're going to do that because we're literally just going to use this simply as a savings account. And I want you to see what's happening here. In the first 4 years, we were putting in $40,000 a year, $160,000 total over the first 4 years, and we have $157,000 of cash value in year 4. Now, we're not going to be doing anything else at all. We're literally just putting it in there 4 years and we're stopping. There's no loans, there's no nothing coming out of it. So this example is fairly straightforward. We're going to fast forward and we're going to jump all the way down here to line 36, age 65, and what we want to do is we want to look at the cash value that's in there at age 65. Well, we can see here that it shows us that we have $1.5 million of cash value, and that shows us being able to take off $92,000 a year until age 85 in retirement, passive, tax-free, passive income. And if we look down here, this is our tally. This shows us that over that 20-year period, we actually took out just over $1.5 million in retirement income. And when we pass, we still pass on $2.4 million in the form of a death benefit. Okay? So really the two big numbers that we want to compare as we move forward is going to be the cash value at age 65 and the retirement income, which is going to be $92,000 in the do nothing example. Got it? Great. Let's move on to example number, let's actually, Nelson reintroduces us to this idea. This is an important page. Nelson introduced us to this idea of the money pool. This is back from page 26, right? And what he's telling us is they're saying there's only one pool of money in the world. And really that idea is this, is that, listen, banks don't sit on money, right? If we know anything about banks up until this point in this book is that banks are very over leveraged. Really who sits on the foundational backbone of our financial economy is going to be insurance companies because they actually have the money. Banks don't. Banks practice fractional leverage, and so fractional banking. Sorry, that was kind of a side note there. But what he's telling us in this is, what he's reintroducing us to in this example is he introduces us to this gentleman that owns a logging company. And he says, okay, Mr. Business Owner, right? You own your business out here, and what has happened is this Great Wall of China is what he calls it, and this is going to be the finance company has inserted themselves between the business owner and this pool of money. And what he's reminding us is that this finance company is not creating any dollars. What they're simply doing is they're approaching the insurance company and they are buying dollars or borrowing dollars, and they're marking them up, and then they're lending them over to the business owner. Okay, so Nelson is going to introduce us, remind us of that idea, and he's also going to say, hey, if we are to create our own banking system and we have our own dollars at deposit in our policy, which we own and control, is we can bypass this finance company and we can tap into those same funds and start to use it for financing our own business needs. Okay, so that's what he introduces us to. That's the concept that he's introducing this to. And there's a couple of specific numbers, some numbers we want to take away from this page. Is down here, he mentions it in the paragraph, but it also says it right here, is this business owner, this logger, is paying the finance company $16,000 a month in principal and interest for these vehicles that he has, 4 trucks, 2 tractors, and a tree shearer. Now these numbers are important, so I'm going to bring them up now. We are going to find out shortly that one truck is going to cost $52,600. And later in this book, he shows us that one tractor is twice as much as a truck. And so we know that that is going to be $105,200. We can also find out the cost of tree shear, but for the illustrations that we're going to go through, we're not going to look at the finance of those, so we'll leave that for now. So, a couple things. Number one, finance company has inserted themselves between the business owner and the pool of money, and what they're doing is they are taking a fee or charging that interest, and they're making a great profit off of it. And what Nelson is going to show us is that let's take over that financing function for these vehicles, and we can start to retain that selves and create our own wealth. And what he's going to look at is we're going to look at what it looks like when we start to self-finance these trucks and tractors. Got it? Okay. Here on this page, this is simply just a bill of sale, and Nelson is again defining the cost of the truck. So really, the important lines on this page is going to be this one: cash price of the vehicle is $52,600, which again I just mentioned. That's going to be the cost of one truck. Okay, and then down here is going to be line number 10, where he talks about the loan repayment schedule. Right here we've got it shows us that we're paying $1,500 a month for 48 months. So we are going to finance $52,600, and we're going to pay back $1,500 a month at 12 months. That's going to be $18,000 a year is what we're going to be paying back. $18,000 a year for 4 years, 48 months, is going to give us $72,000, I believe. Make sure I'm doing my math right. 18,000 times 4, we got 72,000. It's going to be $72,000. Right? So we're going to borrow $52,600 for the truck, and we're going to pay back $72,000. Okay? All right. So equipment financing, illustration number 2. Let's look at the first 4 years in this example. The first 4 years are exactly the same as illustration number 1. We've put in $160,000. We have $157,000 of cash value. But now in year number 5, what you're going to notice is it says a negative or minus $34,600. What does that mean? What that shows us is that we're going to finance, so illustration number 2, I want you guys to think of, we're going to finance one truck. How much is the cost of the truck? We just went through that. We had the bill of sale, and it cost $52,600. And how much are we going to pay back? We're going to pay back $1,500 a month at 12 months. That equals our $18,000. So this is simply just accounting shorthand that shows negative $34,600. So the way to understand this is the beginning of the year we take out $52,600 as a loan against our cash value, and then every single month moving forward we pay back $1,500 a month. At the end of the year we still owe $34,600 on that loan, right? And so that's the way that I want you to read it. And we're going to pay this back $18,000 every year for 4 years until it gets paid off, and then what happens is we finance another truck. Okay? So you can see that this is going to take place every 4 years. And it just continues. Financing one truck every 4 years. Let's dive down here to line 36, age 65, and now how much cash value do we have? Right, we have $1.9 million in cash value, and our retirement income has gone up from $92,000 to $125,000. Okay, how much money have we taken out over a retirement period of 20 years? This shows us right here we've taken out just over $2 million cumulative in total passive tax-free retirement income, and we still have a death benefit at age 85 of just over $3 million. Okay, that's one truck. All right, so logical question is, hey, if my numbers went up from me doing nothing and me financing one truck, what's going to happen if I finance two trucks? So illustration number 3 is simply the two truck example. So we had $52,600 times 2, which gives us $105,200, and we were paying back $1,500 a month. But now we have 2 trucks, which gives us 3,000, right? That's going to give us our 36,000 that you see here. So again, first 4 years are exactly the same. We have 160,000 that we put into the policy. We have 157 of cash value. Year number 5, we're financing 2 trucks at a cost of 105,000, and we're paying back $1,500 per truck. So 3,000 a month over 12 months is 36,000. And if accounting shorthand again gives us 69,200, which is going to be listed. So I hope that helps. Again, we're going to do that every 4 years. If we fast forward, we go down now to line 36, age 65. What is our cash value? Our cash value has now grown again to $2.4 million, which allows us to take off $150,000 of passive tax-free retirement income. And over this 20-year period, this shows us that we've taken out just under $2.4 million of income, and we are still going to pass $3.9 million of death benefit onto the next generation. All right. Illustration number 4, right? Illustration number 4, we're just going to continue. First one, we borrowed 1 truck. Last example, we borrowed 2 trucks. In this example, what we're going to do is we're going to do 3 trucks. So this number 157.8 is simply 52,600 times 3, and now we've got 1,500 a month times 3, which is equal to $4,500 a month times 12. That gives us the $54,000 a year that's going to go back in the form of a loan repayment starting in year 5. Okay? So first 4 years, exactly the same, $160,000 going into it. We have 157. We have 157. We're going to borrow. Yep, we're going to borrow 157,800, and we're going to pay back $3,000 a month. So again, accounting shorthand in year number 5, we got minus 103,800, and we're going to do that every single year for 4 years. And now let's fast every single year, every 4 years until age 65. Take that out. Now how much cash value do we have at age 65? We got $2.9 million. That's going to allow us, that's going to allow us to take out $175,000 in tax-free passive retirement income. And again, this shows us taking just over $2.6 million out in income, and we're still going to pass $5 million on to the next generation. Now here's what I want you to remember. We're going to go to the next illustration here, but in illustration 4, we're doing 3 trucks. In illustration 5, these are exactly the same all the way up until year 13. Okay? What changes, let's do this first, is first 4 years, same exact thing as every example. Put in the same $160,000, we have $157,000. In year 5, just as in illustration number 4, we are financing 3 trucks, and we're paying that back. In year number 13, we have, you can't see this number here, but we have $365,000 of cash value. And essentially what this business owner is asking is saying, hey, what's the most amount of financing that I can do in year 13? Well, if we do the math, the most that we can do is we can do 4 trucks and 1 tractor in year 13. If we do all of these, that ends up being just over $315,000. So let's do the math real quick. We know that 1 truck, again, is $52,600, and we're going to have 4 of those. And 1 tractor is twice as much as a truck, so we know that this is $105,200, right? Let's do the math. So we've got it here. We've got 216, 4,000, 216, 4, and we've got 105, 200, which is going to give us 315,600 is what we're taking out of the policy as a loan against the policy here in year 13. So we're going to take out 315,000, go finance 4 trucks and 1 tractor, and then what we're going to repay is we're going to repay the same thing, right? $1,500 a month for 4 trucks, and we know that 1 truck, 1 tractor, 1 tractor is is twice as much as a truck, and so we know that that's going to be $3,000. So we've got $6,000 and $3,000, trucks and tractor. If we add these two numbers together, we have $9,000. Yikes. $9,000 a month going back to the policy and loan repayment starting in year 13. 9,000 times 12 is going to give us this $108,000 number. That was a lot of numbers. I hope you guys stuck with me there, but the first 13 is exactly like the last illustration. What changes in year 13 is we take on one additional truck and one tractor, which is essentially just doubling the numbers that we had previously. Okay? Now if we fast forward this and we go down to line 36, age 65, how much cash value do we have? Again, we have more. It's $3.5 million is how much cash value that we have, which results in us taking out $225,000 of passive tax-free retirement income for 20 years, which ends up being just over $3.3 million. And we still, at age 85, we pass on $5.2 million of death benefit. Right? So out of the examples that we looked at, which one do you want? I've got notes here. In our do nothing example at age 65, we ended up with $1.5 million. In example number 2, where we financed one truck at age 65, we ended up with $1.9 million. In the third example where we had 2 trucks, it was $2.4, and then we had 3 trucks, which ended up with $2.9 million. And this last example where we financed 4 trucks and 1 tractor, we ended up with $3.5 million in our policy at the age of 65. Out of all of those, which one do you want? Right? Obviously, you want the $3.5 million. Here's the takeaway. The takeaway that I want clients to get after going through this is the more you use this, the better it gets. In the first example, in illustration number 1, the insurance company had 100% control over those of the dollars that are in that policy. And we ended up with $1.4 million. As we started to take control of the financing function of our lives and use those dollars to do the financing ourselves, we ended up with more money, right? So this is almost counterintuitive to almost any other products that are out there, is the more we use it, the better it gets. And that's very difficult to understand. And I hope that that's what the takeaway is on this one. One more thing, a couple side notes is on this page right here, as this shows 79,384. I probably read this book maybe a dozen times before I noticed this number right here. This number should be 108,000. That's what our loan repayment schedule had been every year from year 13 all the way up until 65, and then it drops. It took me a while to realize, A, that it was dropping, and then B, the reason. The reason, and this is the way that I explain it to clients now, is that, did you guys ever have a piggy bank when you were a kid? Right? And you would put nickels, dimes, and pennies, and you just keep shoving them in there. After a while, that piggy bank gets full. And it gets tougher and tougher to shove pennies and coins in there. And at the end, you're shaking this piggy bank to try to fit one more dollar, one more penny, one more quarter into that thing. And at this point, there's no more room. You've shaken that piggy bank as much as you can. You cannot get one more quarter, one more dime, one more nickel, one more penny into this thing. It is absolutely full. And so what Nelson also does in the coming pages is he introduces us to the idea of this is the reason why we need multiple policies. Is if we're doing this correctly, is one policy will not hold will not be big enough for all of our financing needs. And to support that is, if you look at this, in this example, right, we had $9,000 a month that was going back to the policy and loan repayments. At this point, we are literally only about 56% efficient. And the reason that I say that is this. Let's scroll back up to this page. Remember this? Here he says that this logger, this business owner, is paying $16,000 a month to the bank in the form of principal and interest payments. Last example, illustration number 5, we had recaptured $9,000 of that, of the 16, right? we are only about 56% efficient when you compare. There's still room to grow. We could still redirect an additional $7,000 a month back into his own banking system, right? But again, that takes time, and this is just an example, but that's the infinite piece of it, of having this thing grow. There was, in this last example, the questions that I always ask people is, did the guy work any harder between any of these illustrations? No. Same dollars were flowing in, right? Did his cash flow change at all? No. Right? It's the same amount of money that was in his system. The only thing that changed is the amount of control that he exercised over the banking function in his life. So, a lot of numbers. Hopefully I didn't go through that too fast for you, but again, if you missed something, go back and watch this or give us a call. We're happy to go through this. Really good piece here from Nelson. And really, again, the takeaway is the more that we use these policies, the better that they're going to get. So, hope that helps.